Hi everyone, my name is Alex, and if we haven't met before, I am the CEO and founder of Venta Belgarum Associates. So today's video, I am talking capital gains tax. It's a big area of concern for clients within the practice. We deal with it a lot, and we also have to manage the stress levels and worry that comes with it quite a lot, as people are very concerned about the amount of tax they'll have to pay when they have sold something. So I thought I would just dispel a few myths and rumors today and try and ease a few people's minds into the process. So let's get into it. Right, what is capital gains tax? Well, capital gains tax is very basically a tax that's levied on the profit of the sale of an asset. Very simple. What type of assets? Well, we're only talking capital assets. There are about 54, give or take, events in the CGT legislation which the tax applies to, and they range from anything from the sale of a capital asset through to the changing of a structure of a lease, through to entry into the tax consolidation regime, which the big end of town would deal with quite a lot. We don't see quite so much of that in here. But by far and away, the most common one that we deal with is the sale of an asset, the sale of a capital asset. So what type of capital assets are we talking about here? Well, we are talking about things like rental properties, holiday homes, cryptocurrencies, shares, all those types of things. They're the four key ones that we see here most often, is those four. You do have other outliers, but they're the ones that we see a lot of. What are the assets that it doesn't apply to? Well, in this space, and not wishing this to be an exhaustive list, because I could be here all year trying to think up all the different things it doesn't apply to, as well as all the things that it does. So, take this all with a handful of salt. The things that it doesn't apply to are your main residence, although again, there will be exceptions to this, but there's your main residence, and then there's things like personal use assets. So things like your car will not be subject to capital gains tax. We are literally talking about capital assets. So once we've got all those, how do we actually calculate capital gains tax? Well, it's really not as complicated as a lot of accountants will have you believe. It's basically the amount that you sell the asset for minus the amount that you purchase it for minus incidental costs along the way. Now, there are 5 different elements to working out the cost of the asset. So it's called the cost base. So there are 5 different elements to working out the cost base of the asset. And if the asset is loss-making, which I'll go into in a minute, then one of those elements is actually pulled out and you're not allowed to include it anymore, but it is it's the kind of thing that you wouldn't be necessarily including every time anyway, so it doesn't really matter. So to work out your capital gains amount, you are talking the amount that you buy it for minus the amount that you purchase it for minus all the incidental costs along the way. So brokerage, stamp duty, tax, search, title search fees, those sorts of things are all reduced from it. You get what's called your gross gains. So let's just plug a few numbers just to say, for example, here. So let's just say you buy an asset for $100,000, you sell it for $300,000, you have a profit of $200,000. Let's just say your incidental, so that's things like your stamp duty and or your brokerage or those sorts of costs, minus all your other tidbits and pieces, come to say $50,000. So we're down to a gross gain of $150,000. If you've held the asset for more than 12 months and you are an Australian tax resident, then you get to take a 50% discount on that gain, or you should be able to take another 50% discount. So suddenly 150,000 becomes 75,000. Okay. What happens if you've made a loss? Well, if you've made a loss, you have to carry it forwards. All right. What we generally say when it comes to capital gains tax is if you're holding several different assets, then always sell your loss-making assets first, because you can carry forward your capital loss indefinitely. And I mean that under the current legislation, you can carry it forward indefinitely for as long as you like and apply it against capital gains in the future. What I can't do if you've made a loss today is go back and apply it against a gain that you had last year. I can't do that. So that's why we always say sell your loss-making assets first, because we can carry it forward and apply the loss to our $75,000 or $150,000 gain in the future sometime. How does the 50% discount work with losses? Well, with losses, we would take 150,000. If you remember my example with the 150,000, we take 150, we minus the loss off the 150, and then we divide the remaining amount by 50%. And that's how the 50% discount will work with it. Okay, with me so far? all right? The losses can be carried forward forever, okay? You will only lose them when you die or when you use them. End of, okay? How much is the actual tax itself? Well, this is where there's a bit of a misnomer. The tax itself isn't a separate tax. What actually happens is the gain that's left, so the net gain in this case is 75,000 because we've taken 150 and we've minus 50% and we have 75,000. The 75,000 is actually added in with the rest of your assessable income. So if you've been earning during the year, you've got a salary of say 150,000 and you've got interest income of another 10, so we're up to 160,000, and then maybe you have a few deductions in there, so we'll whack off another 5,000, so we're down to 155,000 in terms of taxable income. We add the gain of 75 onto that little lot, okay, and then you are taxed at whatever your marginal tax rate will be. Now, if your gain is only little, it won't actually make a big difference to where you sit in the marginal tax rate brackets. Okay, it really won't make a huge difference at all. However, if your gain is huge, so for example, I don't know whether you'd call it a good news story or a bad news story. I hate delivering bad news to taxpayers when I tell them that they have to pay a tax bill, but I had to deliver a $65,000 tax bill to a client on the sale of her rental property a couple of days ago. Now that's pushed her straight from her normal tax bracket of around the 34 cents on the dollar, so that's the mid-range tax bracket, straight into the top tax bracket for the year. Okay, so what that's done is it's actually pushed her tax rate to 47%, which is, before all you accountants out there start saying that's not the top tax bracket, it's the top tax bracket of 45% plus Medicare levy, which we all have to pay. Okay, so that's how the actual tax itself works. So hopefully today I've dispelled a few rumors. If you like what you see and you want to see more videos along these lines, then please do subscribe to our channel, hit the bell and send me a like, and also send me a message. If you've got any questions and you want to know some more information about capital gains tax, whack it into the comments below and I will respond to you as soon as I can, or you can just contact me on one of the different mediums that you can contact me on that I will list in the comments section below as well. So thank you very much, and I will talk to you again soon.